Rohr here with an early concise highlight on Friday, August 1st, 2014. And yes, it's an employment Friday after a risk-off Thursday. And we're coming to you a bit earlier than usual. It's currently 5:45 a.m. U.S. Central Time, because we want to make sure we get this posted to the blog timely, well ahead of the U.S. employment data release this morning. So, what does all this have to do with how the markets are acting currently? Well, we really think, looking at the short-term charts here at the hourly on the left, 30-minute on the right, that this is really more so a reflection especially after the recovery later on Wednesday to close all the way up in the 1965 area. We think the gap down that we warned before the opening yesterday, if it was below the return line of the current somewhat gradual downward channel from the highs that had held around the 1960 area once again as support, if it was below that return line, the basing line of a downward channel in the 1955 area, you had to watch out for the hourly and 30-minute MACD looping out below their lower runaway bands once again, in spite of the improvement late Wednesday, and that's what happened. So downside acceleration along with a clear sign, pardon me, the market could keep going in spite of the hourly RSI getting pretty oversold earlier yesterday morning, was a sign the market could continue. However, one of the key factors that the bulls, and I think maybe even the bears, were probably not concentrating on or thinking could occur was the subsequent failure later on yesterday below the 1938 to 34 support that is so prominent as the previous congestion, but especially the overrun upside objective of the late May runaway gap. And we will be revisiting that on the intermediate term charts momentarily. So, pardon me. So what do we have here? We have a market that, having broken that support and still being on significant weak tendencies on these on these hourly and 30-minute stochastics, are probably in a position to, at the very least, stall at any rally. You would have to look as nearby as what is now failed Fibonacci support up here around the 1938 to 34 range, and figure even a good number may not cause this market to recover much better than that, and the bigger lower supports are down around the 1900 area. So that pretty much does it for the short-term view of the S&P 500. Moving over to the intermediate-term view, we can see where you had your topping line we had been so keen to point out last week up into the 1985 to 87 area. The market stalled at, and we were asking the question later last week, even before the market broke on Friday, as you go back to Wednesday and Thursday of last week, we were asking, especially in our Thursday piece on the broader context, is this market ready for a real upside acceleration out of this longer-term channel up from the major October 2011 sell-off low, or by not getting out through this channel for a month and a half, was it more so ready for the first serious correction in a while? Well, it looks like we got our answer. And you can see here how the break back below 1950 was not just short-term acceleration out of this downward channel the market had been in over the previous week or so, from the high a week ago Thursday up at the 1985 area, but also was the violation of the previously overrun resistance that should have been support. And here is your lower 1939 at this point Fibonacci, but also the 1938 congestion that the market had stalled into on the way up had overrun back on June 18th and held very nicely around that area to just below it back in late June before the push above the resistance in the mid-1950s. So where does that leave us next? It leaves us looking for further support, even though there was some interim support here around 1915 on the Fibonacci level and some congestion. In fact, the S&P has already been below that and is right around 1915 this morning. We feel the market can probably go back to the lower runaway gaps. This was the gap that set up that higher objective at 1938 that the market is now back below. And that is at the higher level on the continuation, 1904 on the weekly, down to the previous high at 1899. But due to the discount in the September contract, the daily chart is a runaway gap from 1897, and that was back to 1890 area. So that's where we think your most critical lower support probably resides for now, because much below that, it's in a whole lower range that could speak of the market going back to this major lower congestion in the 41-week average, more so back in about the 1855-60 area in the next week, with the actual congestion being in that same sort of area. And that pretty much does it for the S&P 500.